So now let's discuss on financing decisions. I want us to start with the cost of capital. We let me see that? See that? This is the required rate of return. This is the required rate of return. This is the required rate of return by investors, by the investors who have invested their funds. This is the required rate of return by investors who have invested their funds, in the company, who have invested their funds in the company, full stop. They include A, cost of equity, B, we have cost of preference shares. C, we have the cost of the debt stroke debentures. Cost of the debt stroke cost of the debentures. Now let's start with A, cost of equity. Cost of equity is the cost of equity. What have you see that? This is the required rate of return. This is the required rate of return. This is the required rate of return by the ordinary shareholders. This is the required rate of return. This is the required rate of return by the ordinary shareholders. Full stop. Let you see that? Cost of equity is classified into two. Cost of equity is classified into two. Column A, we have cost of retained earnings denoted by KR. Cost of retained earnings. And how do we get the cost of retained earnings? Now, to get the cost of retained earnings, we take DO 1 plus G, PO plus G. Roman 2, we have the cost of ordinary shares noted by KE. Cost of ordinary share. How do you get the cost of ordinary share? Cost of ordinary share is DO 1 plus G, PO minus F plus G, where what is DO, what is G, what is PO, what is F. DO is the most recent dividend per share. G is the growth rate. PO is the current market price per share. F is the flotation cost. Then DO 1 plus G is equivalent to D1, which is equals to the expected dividend per share. Sorry? MPS, market price per share. Then you have to see that flotation cost, another paragraph, flotation cost, stroke issuing cost, stroke issuing cost, stroke issuing cost. Then we explain, see that this is the cost incurred, this is the cost incurred, this is the cost incurred, raise new funds. This is the cost incurred, raise new funds. This is the cost incurred, raise new funds, raise new funds. Full stop. Then I have to say that for retained earning, for retained earning, for retained earnings, there is no flotation cost. For retained earning, there is no flotation cost. You see, retained earning is the money already the company has as a profit. But we're saying that the flotation cost is that cost incurred to raise new funds. So that's why when determining the cost of retained earnings, you just take the market price per share. Also here is the market price per share. But for you to issue new shares, there is that cost incurred in the process of issuing new shares. That's why we deduct the flotation cost here. But for ordinary, for retained earnings, there is no flotation cost because retained earnings, the money already in the company. So you don't incur costs to raise what you already have. Good. Then we have to say that growth rate. See that when growth rate is not provided, when the growth rate is not provided, when the growth rate is not provided, comma, it can be determined using the following two methods. It can be determined using the following two methods. Can be determined using the following two methods. Semicolon. One is compounding method. Compounding method, and in this case, to get growth rate, you take dn over do n root minus 1, where dn is the most recent dividend per share or the last dividend per share. Do was the first dividend per share under the analysis period. Then number two, can use retention ratio. Method. So the retention ratio method, to determine the growth rate, you take RBE, where R is the retention ratio, and then BE is the return on equity. So that's the cost of equity, number B. Look at now cost of preference shares. Denoted by KP. Let us see that. This is the required rate of return. This is the required rate of return. This is the required rate of return by the preference shareholders. This is the required rate of return by the preference shareholder. This is the required rate of return by the preference shareholders. Good. So how do we get the cost of preference share? Now, to get the cost of preference share, you'll take the interest or the dividends. Then you divide it by the value of the preference minus flotation cost. In case there is any flotation cost, you multiply by 100%, where VP is the value of the preference share. Then C, we have the cost of debt or the cost of debenture, denoted by K. Now to see that there are two types of debenture stroke bonds. There are two types of debentures stroke bonds. There are two types of debenture stroke bonds. Semicolon one, we have irredeemable debentures. Irredeemable debentures. Right. These are debentures with no maturity period. These are debentures with no maturity period. Full stop. Right, to see that? They expected to remain outstanding to infinity. They expected to remain outstanding to infinity. Yeah, that's what you call irredeemable debenture. They are those debentures that will not mature. So they meant to the company to perpetuate. So how do we get the cost of the debt in case of irredeemable? So you'll take the interest, you divide it by the value of the debt, then debt is allowable for tax purposes. So you take 1 minus T, where BD is the value of the debt or debenture. T is the tax rate. Then if you write, is that interest on debt is allowable for tax purposes. Number two, we have redeemable debenture. Redeemable debentures. Let you see that. These are debentures with a specific maturity period. These are debentures with a specific maturity period. Full stop. The cost of redeemable debt, is known as yield to maturity. Yeah, that's what we call a redeemable debenture. Saying that these are debentures with a specific maturity period. It's more like a bond. Where you buy a bond for 5 years, that means after 5 years it will mature. So that's what we call a redeemable debenture. They're saying that to get the cost of the debt, in case it's redeemable, will be determined using yield to maturity. And how do you get the yield to maturity? So you'll take the interest plus maturity value minus the value of the debt, 1 over n, all of it divided by the maturity value plus the value of the debt. Then you get the average 1 minus t, where MV, this is the maturity period, sorry, or the maturity value. And debt always will mature at its par value. So the par value becomes the maturity value, and the par value is also known as the nominal value. Then we have VD, this is the current value of the debt. Value of the debt. N is the maturity period. Sorry? No, there is no, they are not powers. They are not powers. NB, right? Is that interest on debt, interest on debt, interest on debt is computed based on the par value. Interest on debt is computed based on par value. Is computed based on par value. It's computed based on par value. That's why you evaluate the cost of capital, the cost of equity, the cost of preference share, and then the cost of the debenture. Good. So instead of that, I want us to look at something else. A subheading, weighted average cost of capital. That's WACC. Weighted average cost of capital. WACC, right? You see that? This WACC is the overall cost of capital. Is the overall cost of capital of existing funds, is the overall cost of capital of the existing funds already invested in the company, already invested in the company. Full stop. Can I just say that? Therefore, WACC does not consider flotation cost. WACC does not consider flotation cost. Remember, you see that flotation cost is the same as issuing cost. The cost incurred to raise the new funds. But you see, we are saying that WACC is the average cost of the existing funds. So that means it's something that you already have. So in this case, we are not incurring additional cost. Then let me say that WACC is used as a discounting factor. WACC is used as a discounting factor when evaluating existing project. when evaluating existing projects, first. So how to determine the WACC? Now, WACC, remember you said that is the overall average cost of the existing funds. So you say that we have the cost of equity, we have the cost of preference, we have the cost of the debt. So how does the company determine one cost of capital? So to determine the average cost of capital, we compute the WACC by taking weight of equity, cost of equity, weight of preference, cost of preference, weight of the debt, cost of the debt. Remember, you see that the cost of the debt is allowable for tax purposes. 1 minus T, where W means the weight. W means the weight. Then you need to see that. WACC does not consider the cost of retained earnings. WACC does not consider the cost of retained earning, Full stop. This is because its value is already included. Its value is already included in the market value of ordinary share. Its value is already included in the market value of the ordinary share. Now we look at the weighted marginal cost of capital. That's WMCC. Where to see that? WMCC is the overall average cost. WMCC is the overall average cost of capital, for the new funds to be raised by the company, It's evaluated as follows. Yeah, so how do we get the WMCC? Now, to get the WMCC, the formula is the same as the one for WACC. You take the weight of equity, cost of equity, weight of preference, cost of preference, weight of the debt, cost of the debt, 1 minus T. Yeah, you can see the formula are the same. But the difference we are saying that WACC is the average cost of the existing fund, but WMCC is the average cost of the new fund. Then we need to say that WMCC considers flotation cost. Since it's used to evaluate, WMCC considers flotation cost. Since it's used to evaluate new funds, to be raised. First, and you have to see that WMCC is used as a discounting rate. WMCC is used as a discounting rate, is used as a discounting rate when evaluating new project. Is used as a discounting rate when evaluating new projects. When evaluating new projects. When evaluating new projects. So now let's look at the differences between WACC and WMCC. So on one side we have WACC, the other side we have WMCC. Number one, on the side of WACC, is the overall average cost, is the overall average cost of capital of the existing funds, On the other side, is the overall average cost, of the new funds, to be raised, Another difference on the side of WACC does not consider flotation cost, On the other side, it considers flotation cost. Another difference on the side of WACC does not consider the cost of retained earnings, On the other side, it considers the cost of retained earnings. Another difference on the side of WACC, it's used as a discounting rate. When evaluating existing projects. On the other side, it's used as a discounting rate. When evaluating new projects. It's used as a discounting rate when evaluating new projects. Another difference on the side of WACC, it uses market values. To determine the weight stroke proportion. Yeah, I mean this weight. To determine the weight stroke proportions. On the side of WMCC, it uses the optimal capital structure. To determine the proportion. Now let's look at breakpoint stroke return point. or stroke critical point. Breakpoint, stroke return point, stroke critical point. Let us see that. This is a point whereby, this is a point whereby, this is a point whereby a given source of capital is finished. This is a point whereby, this is a point whereby a given source of capital, is finished, and the investors decide, and the investor decides to use the next expensive, and the investor decides to use the next expensive source of capital, and the investor decides to use the next expensive cost of capital. The next expensive cost of capital. Yeah, that's what we call the breakpoint. You're saying that breakpoint is a point whereby a given source of capital is exhausted or is finished, and the investor opts to use the next expensive source of capital. Now, for example, in a company, if you want to raise the equity capital, we have retained earnings, and you can issue new shares. The cheaper one is retained earnings because the money generated internally. So at what point now, when the retained earning will be exhausted, now the company will go to the next expenses of capital, which is the issuing new shares. Now that point is what we call the breakpoint. And how to determine the breakpoint? Now to determine the breakpoint, you'll take the amount trace, you determine, you divide by the weights, stroke the proportion. Yeah, amount trace, you divide by the weight, stroke proportions. Good. So now let's do some illustration. May 2017, question 4B. May 2017, question 4B. Rui Limited has a bond that has 3 years to maturity. So that means it's a redeemable bond. The bond par value is 1,000. Yeah, we say that the par value will be the same as the maturity value. So the maturity value will be the same as par value, of which we are told it's 1,000. Yeah. Coupon payment for the bond is made annually. The current market value of the bond is 120% of the par, with a coupon of 12%. Yeah, the current market value, that's what we call the value of the debt. It's 120% of the par value. Remember, the par value is 1,000. So that means the current value of the debt is 1,200 with a coupon of 12%. So the coupon helps us determine the interest. So take 12%. I gave you a point that interest will be computed based on the par value. Interest will be computed based on the par value, and the par value is 1,000. So that means the interest per bond per year is 120. Required. The yield to maturity. How do we get the yield to maturity? Now, this one is a redeemable bond, which is redeemable for 3 years. So yield to maturity is that you take the interest plus maturity value, value of the debt, 1/n, plus maturity value plus the value of the debt. You get the average. then 1 minus t. Now, in this case, we ignore 1 minus t because we are not given the tax rate. If you're not given the tax rate, you ignore the tax benefit. So in this case, we will not use 1 over t. I mean 1 minus t. So therefore, the yield to maturity will be, you take the interest, which is 120, plus the maturity value. Maturity value is 1,000, minus the value of the debt, and the current value of the debt is 1,200, 1 over n. The maturity period was 3 years. Then you take 1,000 plus 1,200, then you get the average 1 over 2. And what do you get? Now do this. 200 divided by 3. 200 divided by 3. 120 minus answer. 120 minus answer equals, divided by 1100. Divided by 1100. Divided by 1100 times 100%. Times 100%. What do you get? Sorry? 4.8. 4.8%. As simple as that. So open December 2012. December 2012. Question 2E. December 2012, question 2E. Nazir Investment Limited currently sells the bond at 1,200. Currently sells the bond. Now that's what we call the value of the debt. Currently sells the bond at 1,200 with 11% coupon rate and 1,000 par value. So the par value is the same as the maturity value, which is 1,000. The coupon rate is 11%. So that means the interest, it will take 11% of the par value. And the par value is 1,000. So you get 110. The board agreement provides for payment of interest on annual basis with 18 years maturity period. So it's redeemable, where N is 18 years. So also in this case, you're not given the tax rate, so you know the tax shield benefit. Required, the board yields to maturity. So that yield to maturity, you'll take the interest plus maturity value, value of the debt, 1 over n, maturity value plus the value of the debt, you get the average, 1 minus t. But in this case, there is no tax rate. Now, in here, there is tax rate, you multiply by 0.7. So you'll take the interest, of which interest is 110, plus you take the maturity value, which is 1,000, minus the value of the debt, which is 1,200, 1 over n, n is 18 years, all of it you divide by 1,000 plus 1,200, then you get the average. Assuming there was tax rate, you could have multiplied by 0.7 and then times 100%. But in this case, you're not given the tax rate, so ignore that. So what do you get? Sorry? 8.99. 8.9%. So you can copy now. September 2021. September 2021, question 5B. Now let's start with question 5A. Differentiate between the following terms as used in capital budgeting decision. Number one is the hard capital and soft capital. Now, hard capital, in short, they are long-term capital. Soft capital, they are short-term capital. Number two, sunk cost and opportunity cost. Now, sunk cost is what we call historical cost. Cost already incurred. That's what we call sunk cost. So sunk cost is the same as historical cost or cost already incurred. That's what we call sunk cost, cost already incurred. Then we have opportunity cost. Now, opportunity cost is the benefit foregone. Benefit foregone. Yeah, so opportunity cost is the benefit foregone. And then number three, we have independent projects. So that independent project, they are project which does not interfere with any with other projects, and they are projects serving different purposes. And mutual exclusive project, they are projects which are substitute. Yeah, substitute, that means that if you undertake project A, you ignore or you reject the other project since they are serving the same purpose. In short, they are what we call substitute project. They compete against each other. You get your 6 marks. Number B of the question. The management of Biashara Limited are in the process of determining the optimal capital budget for the company for the year ending that 1st December 2021. Yeah, so that is WMCC automatically. Why is it a WMCC? That WMCC is the average cost of the new funds to be raised. So in this case, they are coming up with a budget. Budget, remember, you plan in advance. So they are planning to raise new funds. They are planning to raise new funds. That means we are already using WMCC. Another thing, for WMCC, we see that we consider flotation costs. We also consider the cost of retained earnings. Good. The following information is available. Number one, the profit after tax for the year ending that 1st December 2021 is estimated to be 22.5. Yeah, that's the expected profit or retained earnings at the end of the year. I mean, profit. The retention ratio is 60%. So how much is the expected retained earnings? Now we are told that retention ratio is 60%. So they retain 60% of the profit. And you are told that number one, the profit after tax for the year ending that 1st December 2021 is expected to be 22.5. So the expected profit is 22.5. Then they retain 60%. So that means the retained profit will be 13.5. Good. Number three. The ordinary share of the company are currently trading on security exchange at 80 shillings per share. Now that's PO. Write that. PO. Number four. Ordinary shareholders expect a dividend of 6. What is that? What is that? That is, hey, cost of equity. I think we wrote everything there. Eh? Inamaanisha nini? Cost of equity. Andika P1. Andika, sorry, D1. Andika D1. Andika D1. We said what is D1? Expected dividend per share. And this is what we are given, that the ordinary shareholder expect a dividend of 6. per share for the year ending that 1st of December 2021. So that's D1. The annual growth rate in dividend is 6% per annum. So that's G. Flotation cost amount to 8 shillings per share. That's F. The company could issue an unlimited number of 11% preference share at 96 per share. The par value is 100 shillings. The company could obtain a bank loan of up to 24 million at a pre-tax interest rate of 10% per annum. Thereafter, an unlimited amount of bond could be issued under the following terms. Coupon interest rate of 12% per annum, par value of 1,000 shillings per bond, discount of that shillings per bond, flotation cost of 20 shillings per bond, maturity period of 10 years. So these are yield to maturity or redeemable bond. Number 9, the optimal capital structure of the company comprises of 15% debt, 40% preference share capital, and 45% equity. The corporate tax rate is 30%. Required. 1, the cost of capital for each source of finance available to Biashara Limited. The cost of capital for each source of finance. So we start with the equity. Equity, there are two. We have the cost of retained earnings and the cost of ordinary shares. Then you also need to compute for the cost of the debt, I mean cost of the preference share. Cost of preference share. We also need to get the cost of the debt. Cost of retained earnings is that DO1 plus G, PO plus G, which is equivalent to DO1 plus G, you say that is equivalent to D1. Then you divide by PO plus G. Cost of ordinary share, it's DO1 plus G, PO minus flotation plus G, which is equivalent to DO1 plus G, is the same as D1. Then you divide by PO minus F plus G. And in this case, we are given D1. That's the expected dividend. Number 4, the ordinary shareholders expect a dividend of 6. We have 6. You divide by PO. How much is our PO? We have 80. Also here 80. But for ordinary share, you deduct the flotation cost, the cost of issuing those shares. How much the flotation cost per share? 8. Then we add the growth rate. How much is the growth rate? 0.06, 0.06. Now give me that in percentage. Give me the cost in percentage. Sorry? 13.5%. Then we need the cost of preference share. Now, cost of preference share, you take the interest or the dividend, you divide by the value of the preference minus flotation, in case there is any flotation cost, then you multiply by 100. We say that interest is computed based on the par value. Note number 7. The company could issue an unlimited number of 11% preference share at 96. Now, that 96 is BP. Can you write that? That's the value of the preference. The par value is 100. The par value is 100. So to get the interest, the coupon rate is 11% of the par value, which is 100. You divide by VP, and VP are given it's 96. So don't raise flotation cost because we are not given the flotation cost. The flotation cost we had been given, that was for ordinary shares. Then you multiply by 100%. You get 11.5. 11.5%. Then determine the cost of the debt. Now, the cost of the debt, the company could obtain a bank loan of up to 24 million at a pre-tax interest rate of 10% per annum. So here we have two debts. Number 1, we have for the loan. Let's go back where you wrote about the cost of the debt. Where you wrote about the cost of the debt. The last one was the cost of redeemable debenture. I want you to add an NB somewhere where you have the cost of the debt. NB, receive that. In case of loan debt, in case of our own debt, in case of loan, I mean this, in case of our own debt, comma, the cost of the debt will be determined as follows. The cost of the debt will be determined as follows. The cost of the debt will be determined as follows. In case of our own, to get the cost of the debt, you just take the interest rate 1 minus T. Show that. So in case of our own, we are saying that to get the cost of the debt, you take the interest rate 1 minus T. And you know that in note number 8, the company could obtain a bank loan of up to 24 million at a pre-tax interest rate of 10% per annum. So the cost of the debt of the loan, you take the interest rate, which is 10% per annum, of which it was pre-tax. Then you take 1 minus T. The tax rate was 30%, and you get 7%. Then you do that. Thereafter, an unlimited amount of bond could be issued under the following term. So apart from loan, we have another debt. That's the bond. Coupon interest rate 12% per annum. Par value 1,000 per bond. Discount of 30 shillings, flotation 20 shillings, maturity period of 10 years. So that means this one is a yield to maturity. So you have another cost of the debt for the yield to maturity. So that you take the interest plus maturity value of the debt, 1 over n, maturity value plus the value of the debt, you get the average 1 minus T. And we have the interest. The coupon interest rate is 12% per annum, so we'll take 12% of the par value. The par value is 1,000 per bond, so we'll get 120. The maturity value is the same as par value, of which we're given it's 1,000. We also need the value of the debt. Now, to get the value of the debt, you take the par value, which is 1,000, but we are going to incur a discount. You give them a discount of 30. Also, there will be flotation cost of 20. So that means they'll get a net of 950. That's how we get the value of the debt. So therefore, to get the yield to maturity, you take the interest, of which the interest is 120, plus maturity value. Maturity value is 1,000, minus the value of the debt, 950, 1 over n. Maturity period is 10 years, so it's 1 over 10. You divide by 1,000 plus 950, then you get the average. Then you multiply by 1 minus T. Tax rate was 30%. 1 minus 0.3, you get 0.7. Good. So take 1950 divided by 2. 1950 divided by 2. 125. 125 divided by answer times 0.7 times 100%. You get 0.97, which is approximately 9%. Let's work with 9%. As simple as that. Sorry, why?
Why we less credit?
For flotation cost. See, to get the value of the debt, you see the value of the debt, they'll give a discount, then they'll incur some cost to raise that fund. So in short, the total cost will be 50 shillings. Ama, you're not supposed to deduct it.
I thought we are supposed to add it because it's an actual cost.
No. You see the par value is 1,000. You are selling this bond at 1,000, but for you to get that 1,000, you have to give them a discount of 30. Then you incur some cost 20. So how much did you realize? 9. You don't realize more, you realize less. Yeah, so I didn't say you copy. Hatujamaliza swali. That was part A of the question. Can we go to part 2 of the question? Part 2 of the question, you were told that the breakpoint in the marginal cost of capital schedule with respect to retained earnings and the debt. The breakpoint. So that to get the breakpoint, you take the amount trace, you divide by the weights or the proportion. And with that, breakpoint is a point whereby a given source of capital is finished and the investor helps to go to the next expensive source of capital. And how do you determine the breakpoint? Now listen here. For determining the breakpoint, you want to determine for the source of capital which you have the specific amount. This is what I mean. For example, for equity, we have two: cost of retained earnings, cost of ordinary share. Now for the ordinary share, we are not given the amount raised from the issue of share. But for retained earnings, we know that retained earnings will be 13.5. So we'll compute number 1 for retained earnings. Also for the debt, we have two debts. We have the loan, we have bonds. Now for the bonds, we are not told the amount raised from the bond, but for the loan, we are given the amount. Can you read number 8? The company could obtain a bank loan of up to 24 million. So that means they are very specific. So for the debt, you compute for the loan. Though in the question, that's what they have asked. But sometimes you'll be told that determine the breakpoint, full stop. So I repeat again. For breakpoint, you only compute from the source of capital of which you are given the specific amount. For ordinary share and retained earnings. Ordinary share, you're not given the specific amount, but for retained earnings, you know it's 13.5. For the debt we have for the loan, we have for the bonds. For the bond, we have not specified the amount raised from the bond. But for the loan, you are told that you can get up to 24 million. And that's what the question was asking. Can you go back to number 2 of the question? The breakpoints in the marginal cost of capital schedule with respect to retained earning and debt. So in this case, they are very specific. So in case they are not specific, that's how you identify how to compute the breakpoint. So you start with the retained earnings. You take the amount raised. So now the amount to get from the retained earnings at the end of this financial year will be 13.5. Then for the debt, 24 million. Then you divide by the weights. Weights are the same as the proportion. Note number 9. Note number 9. The optimal capital structure of the company comprises of 15% debt. So the proportion, the weight of the debt is 15%, 0.15. 40% preference share capital and 45% equity. Retained earning is part of the equity. So divide by the proportion of equity, which is 45, 0.45. What do you get? You get? For the loan is 160 million. This one is 30 million. Now, can you listen up here? Listen up here. I want to interpret what it means. Retained earning, it's part of equity. And for the equity, we say that they are classified into two. We have the cost of retained earnings and cost of ordinary share. We have the cost of retained earnings, which is 13.5, and we have the cost of ordinary share, which is 14.3%. Also for the debt, we have two. We have for the loan, which is 7%. And then we have for the yield to maturity for the bond, which is 9%. And what does it mean? Retained earnings, it's part of the equity. And equity, we have retained earnings, we have ordinary share. So what it means is that the breakpoint for retained earnings is how much? 30. So that means for it to raise any equity capital between 0 to 30, we can be able to afford from the retained earning, which is cheaper. You see the cost of retained earnings is cheaper at 13.5. But now for us to raise any capital above 30 for the equity, we go to the next expensive source of capital, which is issuing of new shares, which is expensive at 14.3%. So anything to do with the equity between 0 to 30, we can afford from retained earnings, which is cheaper at 13.5. But for us to raise any additional equity capital above 30, we go to the next expensive source of capital, which is issuing of new shares, which is expensive at 14.3. I interpret the same for the debt. Debt we have two. We have loan, we have then the bonds. Loan is cheaper at 7%. Bond is expensive at 9%. 9%. Now the question is, the maximum amount we can raise from the loan is 160. So that means for the debt between 0 to 160, you can be able to afford from the use of the debt. I mean from the use of loan, which is cheaper at 7%. But to get any debt above 160, that's when you go to the next expensive source of capital, which is issuing of bonds, which is expensive at 9%. 9%. Good. Number 3. The marginal cost of capital schedule at each breakpoint identified in B to above. The marginal cost of capital, that's WMCC. The WMCC is that is the weight of equity, cost of equity, weight of preference, cost of preference, weight of the debt, cost of the debt, 1 minus T. Now the question is, how many WMCC do we compute? Now the number of WMCC to compute will depend on the number of breakpoints. How many breakpoints do we have? We have 2, not 4. We have 2 breakpoints. The one for that, the other one for 160. So if you have 2 breakpoints, you compute 3 WMCC. If you have 3 breakpoints, you compute how many WMCC? 4. You just add 1. Are you together? If you have 5 breakpoints, you compute 6 WMCC. What does it mean? This is what it means. You take 0, then you take the minimum breakpoint, which is 30. So between 0 to 30, then above 30 to the next one, which is 160, and then above 160. Yeah, when you have 2 breakpoints, you compute 3 MCC. How do you get the WMCC? You take the weight of equity, cost of equity. Weight of equity. Can you go to note number 9? Give me the weight of equity. Ningape? Sorry? Is that 40 or 45? Is that 45? So weight of equity, I've taken 0.45. Weight of equity, cost of equity. So now reason here. Cost of equity, there are 2. We have the cost of ordinary share, cost of retained earnings. Cost of ordinary share, cost of retained earnings. For retained earnings, we have the breakpoint, which is 30. So between 0 to 30, we use the cost of retained earnings. Above 30, we use cost of ordinary share. Between 0 to 30, we use the cost of retained earnings, which is cheaper at 13.5. Anything above 30, now we go to the next expenses of capital, which is issue of new shares. 14.3, 14.3. Then we had weight of preference, cost of preference. How much was the weight of preference? 40%. Then you multiply by the cost of preference. Now, cost of preference is always 1, so that one won't change. So it remains to be 11.5, 11.5, 11.5. Plus, weight of the debt was 15%. Then you multiply by the cost of the debt. Cost of the debt are 2. We have for the loan 7%, we have for the bond 9%. So for the debt, we have the breakpoint for loan, which is 160. So between 0 to 160, we use the cost of the loan. Anything above 160, that's when you use the cost of the bond. Between 0 to 160, that means the 2, we use 7. Anything above 160, that's when you go to the expensive one, which is at 9. Above 160, 9%. Then there is 1 minus T. So in this case, you don't factor 1 minus T, because when you're determining the 7% was already net of tax. Also, this 9% was already net of tax. So give me that. Uh-huh. 12.385%. Huh? Yes. 11.73%. Sorry? 0.0. Good. So you can copy now. May 2014. Question 4B. The following is the capital structure of Ghana Limited. So we have the ordinary share capital, we have the preference share capital, we have the debentures. So automatically this is WACC. Additional information. The shareholders of Ghana Limited expect earnings and dividend to grow at a constant rate of 5% in the future. Now that's G. The company has just paid a dividend of 4 shillings per share. Have just paid. Now that's what we call DO, the most recent dividend per share. Write it as DO. Number 2, the current market price of one ordinary share of Ghana Limited is 80 shillings. That's PO. Treasury board yield 12%. The return on the market is 14%. The company beta is 1.5. You can ignore that. Eh? That one you can ignore because you're already given, you know how to get the cost of retained earnings. Eh? Now in advanced level, there is another formula known as CAPM, where you get the return of the security, which is equals to risk-free, expected return of the market minus risk-free, you multiply by the beta. And this is equivalent of getting the cost of ordinary shares. But since in this case, you're given the dividend per share, you're given the market price per share, use the one you know. But also you can use CAPM. But this one is not at your level now. Number 4, a new preference share can be sold at 120. That's VP. With a dividend of 12 shillings per share and a flotation cost of 6. The corporation tax rate is 30%. The company pays out all its earnings as dividends. The company will sell 12% debenture with a maturity of 10 years at 90 per debenture. The par value of the debenture is 100 shillings. Required. Using the market values, calculate the WACC. Compute WACC. How do you get the WACC? The weight of equity, cost of equity, weight of preference, cost of preference, weight of the debt, cost of the debt, 1 minus T. So first of all, determine the weights or costs. Yeah, first of all, get the cost of equity, get the cost of preference, cost of the debt. Now, for the cost of equity, you see that when you're determining WACC, we don't factor in the cost of retained earnings. The differences, go back to the differences. I think that was on the difference between the WACC and WMCC. For WACC, we don't consider the cost of retained earnings, so it's only the cost of ordinary share. And how do we get the cost of ordinary share? So it's DO 1 plus G PO minus flotation. But in this case, we're evaluating the existing funds, so there is no flotation cost. You can only consider the flotation cost for the preference share, but not for ordinary share. Then we add the growth rate. How much was DO? For 1 plus the growth rate. How much is G? 0.05. Then you divide by PO. 80 shillings. There is no flotation cost for ordinary share. Then you add the growth rate 0.05. Now give me in percentage. $10.5%. 10.25%. Then you get the cost of preference. Now, to get the cost of preference, you take the interest of the dividend over the value of the preference minus flotation in case there is any flotation times the 100%. In note number 4, new preference. You see, in this case, we are not talking about the preference. We are talking about the new preference. So that means is a new capital. New preference share can be sold at 120 per share with a dividend of 12 per share. So the interest of the dividend is 12. Can be sold. The value of the preference will be 120. And that in this case, we're talking about the new preference share. With a dividend of 12 and a flotation cost of 6. So you multiply by 100. So what do we get? 12 over 114 times 100. 10.53%. Then lastly, we need the cost of the debt. Now, cost of the debt, it depends whether it's redeemable or irredeemable. Is it redeemable or irredeemable? This is irredeemable. Hakuna mahali umepewa maturity period ama umepewa. Yes, you are given. Yeah, number 7. The company will sell a 12% debenture with a maturity of 10 years at 90 per debenture. The par value of the debenture is 100. So this one is redeemable. So it's yield to maturity, which is interest plus maturity value minus the value of the debt, 1 over n, maturity value plus the value of the debt, 1 over 2, then 1 minus 10. We need to get the interest. Interest to that number 7. The company will sell 12% debenture. So it will take 12% of the par value. 12% debenture with a maturity of 10 years at 90 per debenture. Now that 90 is what you call VD, the value of the debt. The par value of the debenture is 1,000. So it's 12 over 100. Yeah, over 100, which is 12. Maturity value is the same as par value, which is 100. The value of the debt, they'll sell it at 90. So that means yield to maturity will be, you take the interest, which is 12, plus maturity value. Maturity value is 100, minus value of the debt, which is 90, 1 over n. N we are told is 10 years. Good. Then you divide by 100 plus 90, you get the average. 1 minus is 0.7. In this case, we're given the tax rate. That one you take 13, you divide by 95 times 0.7 times 100. 9.6. 9.6%. So now we have the cost of equity, cost of preference, cost of the debt. Now we need the weights. How do we get the weights? To get the weights, now can you go back to the difference between WACC and WMCC? The difference between the two. Now let's go to the last difference. The last difference was that for WACC, how do you determine the weights? We use the market values. Yeah, for WACC to get the weights, you get the market value. But for WMCC, use the optimal capital structure. Optimal capital structure, that means that the weight does not change. Like the question we did, we are told that the debt was 15%, preference share 40%, and then ordinary equity was 45%. That one does not change. That's what we call the optimal capital structure. But for WACC, we use the market value. So we need to get the value of equity, weight of preference shares, and for the debt. And this is how you get. It's very simple. Now let's go to the optimal capital structure. We are given that. And this is the ordinary share capital. Ordinary share capital power is 100, which is 80 million. This is what you do. You will take 80 million, you divide by the par value, which is 100, so that you get the number of ordinary shares. So I've taken the ordinary share capital, which is 80 million. You divide by the par value to determine the number of ordinary share. Now, once you get the number of ordinary share, you multiply by the current market price per share. How much is the current market price per share? Your PO. How much was PO? 80. Good. Is that 64? So the current value of the equity is 64 million. We do the same for the preference. How much was the preference share capital? It's 35 million shillings. Then you divide by the par value of 100 so that you get the number of preference share. Once you get the number of preference share, you multiply by the current market price of the preference share. Note number 4. New preference share can be sold at 120 per share with a dividend of 12 and a flotation cost of 6. Now, this is what you do. The current market price is 120, but there will be cost incurred of how much? 6. That means you'll get a net of 114 per share. So you take 0.35, you multiply by 114. Sorry?
That's fine.
That's 9.9. Lastly, for the debt, we have debenture. How much is the debenture capital? Yeah, it's 27 million. You divide by the par value, which is 100, for you to get now the number of debentures. Once you get the number of debenture, you multiply them by the current market value of the debenture. Note number 7. The company will sell a 12% debenture with a maturity of 10 years at 90 shillings per debenture, each at 90. You get? 24. Right? 24.3.
Yeah.
24.3. Good. So now write that the total current value. Sorry? 128.2. Now let's convert this one into weights. 64 over the total, that 9.9 over the total, 24.3 over the total. So convert it into proportion. Sorry? 0.5. Sorry? 0.31. So that means we can now be able to get WACC. So WACC is that it's weight of equity, cost of equity. Weight of equity is 0.5. You multiply by the cost of equity. Cost of equity you have is 10.25 plus weight of preference, cost of preference. So the weight of preference share is 0.31 multiplied by the cost of preference share, which is 10.53. Weight of the debt, cost of the debt. So the weight of the debt we have is 0.19 times the cost of the debt. Now the cost of the debt yield to maturity was 9.6. Then 1 minus t. But in this case, when determining the 9.6 was already net of tax. So don't factor in the tax again. So what do you get? 10.16. So you can copy. Now in our next session, still we'll be doing more questions on WACC and WMCC. So meanwhile, you can go and try this question. Go and try November 2019. This one once again.